China has shattered expectations and seized the moment, delivering a blow that has upended the global economic order. Once the unrivaled leader, the United States now finds itself staggering under the weight of its own miscalculations. The world watched as Washington demanded China surrender its so-called currency weapons. But in a twist no one predicted, it was the US dollar that collapsed, triggering tremors through every corner of the international financial system. Factories across America are gasping under punishing tariffs, while shipping volumes from China have nosedived by 60%, signaling a seismic shift in global trade. Retail giants, Walmart, Target, already operating on razor-thin margins, are now teetering on the edge. Empty shelves are no longer a threat. They are a countdown, a matter of weeks. As Washington scrambles, its political demands sound increasingly hollow. Trump's calls for Britain to abandon its economic ties with Beijing are met with silence, even resistance. Behind the curtain, China moves with quiet confidence, executing a strategy that has been in motion for years. This is not mere retaliation. This is economic warfare, and China is winning it. The United States, in a desperate bid to gain leverage, weakened its own currency. But that gambit has turned into a catastrophe. Since January 2025, the dollar has plunged nearly 10%, but instead of fueling a manufacturing revival, it has ignited a firestorm of inflation. The economy, still deeply entwined with Chinese supply chains, is choking on rising costs and logistical chaos. Tariffs, some soaring to 145%, were supposed to break China's back. Instead, they've ensnared America in a trap of its own making. With no alternatives in sight, U.S. businesses are forced to swallow higher costs or cut operations. The dollar, once a weapon, is now a liability. You can't devalue into a supply shortage, warned Moody's Mark Zandandi, distilling the crisis into a brutal truth. What was meant to be a clever maneuver has become a slow bleed. Meanwhile, China's grip only tightens. The yuan has remained unnervingly stable, slipping just 3.2% even as markets roil. In contrast to the panic and volatility engulfing the West, Beijing is calm, calculated. It has pumped over $1.5 trillion into its economy, targeted, precise stimulus that fuels domestic demand without sowing instability. Exports continue to surge, and China's trade surplus grows, its position hardening while the United States falters. Far from collapsing under pressure, China has weaponized stability. As the dollar sinks, Beijing quietly consolidates power, presenting itself not just as a rival, but as the new center of economic gravity. In the US, time is running out. April 2025 brought grim numbers. Chinese shipping to American ports had dropped 61%, and the National Retail Federation is warning of disaster. Major retailers may see their shelves go bare in just 5 to 7 weeks. The cause? The very tariffs designed to punish China. Prices for everything from electronics to clothing are surging. Consumer electronics are up 32%, furniture 45%. In March alone, the core goods index rose 1.1%. The inflation crisis is no longer looming, it's here. Washington insists the tariffs are just temporary leverage, but the clock is ticking, and leverage means nothing if the system you're using it on collapses first. America's industrial core is eroding. The March 2025 industrial report revealed a 0.6% drop in factory output and capacity utilization down to 76.8%. The reshoring promises ring hollow, as the numbers betray a grim truth. The rebuilding of America's industrial backbone is years behind. Construction costs are rising, machinery is scarce, and both are tied to Chinese suppliers. The labor market isn't offering salvation either. Manufacturing job openings are down 17% year over year. Without materials, machines, or manpower, the weakened dollar has only made everything more expensive. Economist Mohammed Alaron didn't mince words. This isn't dollar diplomacy, it's dollar dysfunction. And the markets have begun to agree. China's central bank has moved with surgical precision, exploiting the dollar's decline to entrench its dominance. The yuan has stayed within a tightly controlled band, maintaining China's export edge while insulating its economy from global turmoil. The massive liquidity injections into its banking system, over $1.5 trillion, have ensured stability, resilience, and a continued trade advantage. Exports remain strong. Surpluses are climbing. Beijing isn't reacting, it's orchestrating. And while the US reels from blow after blow, China is laying the groundwork for sustained dominance. Every quiet move, every measured response, every bit of restraint has been part of a deeper play. To stabilize the yuan while the dollar unravels, to build industrial might while others argue about tariffs. Across the Atlantic, Britain is caught in the storm. US pressure is intensifying, demanding that the UK sever economic ties with China. But the numbers don't lie. In 2023, China accounted for 7.3% of British imports and 4.1% of exports. Entire sectors, especially electric vehicles, depend on Chinese batteries and components. Chancellor Rachel Reeves has been blunt. Cutting ties with China would be reckless. And yet Washington keeps turning up the heat. The London Stock Exchange is still considering Chinese IPOs, even as Parliament debates their political cost. Britain is walking a razor's edge, torn between the demands of an aging ally and the unavoidable reality that China is too vital to abandon. The real question is no longer whether Britain should comply, but whether it can survive doing so. The world is changing. The economic order that defined the last century is dissolving before our eyes. America's position at the top is no longer assured. Its once unstoppable economic engine is sputtering, weighed down by policies that have backfired and strategies that underestimated the adversary. China, deliberate and unyielding, is stepping forward. The yuan stands firm, the dollar wavers, and Beijing is poised to take the reins of a new global era. This is not just a financial crisis. It is a realignment of power, a changing of the guard. And right now China holds the high ground. The fight is no longer just about economics, it's about influence, alliances, and the future. Peter Navarro's fierce attacks on Britain in The Telegraph, calling it a compliant servant to communist China, echo the desperation of a fading order. But London isn't yielding, it's resisting. And around the world, capitals are watching, choosing sides, and preparing for a reality where the United States may no longer lead. Chancellor Rachel Reeves has not minced words when it comes to the UK's relationship with China. She has repeatedly warned that any attempt to sever economic ties with Beijing would be nothing short of a strategic blunder, a move that could further damage a British economy already struggling with stagnant productivity and widening trade deficits. The numbers back her up. In 2023 alone, the UK's trade with China totaled $62.6 billion, making up nearly 7% of total goods exchange. For sectors such as electric vehicles, pharmaceuticals, and advanced manufacturing, this connection isn't just beneficial, it's critical. And yet, as Washington intensifies its call for economic decoupling, the UK is charting its own course. Rather than falling in line with the US's increasingly aggressive stance toward Beijing, Britain is pursuing a path of cautious engagement. Officials have continued to welcome targeted Chinese investment, and in a particularly symbolic gesture, there have even been discussions about facilitating a Shanghai-based company's IPO in London. This is more than a financial transaction. It's a diplomatic signal that Britain isn't prepared to follow the US down the road of hardline economic separation. A recently leaked cabinet briefing, reported by The Guardian, underscores this strategic divergence. Inside the UK government, there's mounting skepticism toward the American approach, which leans heavily on tariffs, export controls, and public posturing. One senior advisor went so far as to label Washington's demands economically self-destructive, highlighting a growing sense that blind alignment could come at a steep national cost. As Washington turns up the heat, London is recalibrating. The UK's pivot isn't passive. It's a deliberate move toward economic resilience and strategic autonomy. The confrontational language coming from American figures like Peter Navarro only adds tension to the atmosphere. In an April speech, Navarro warned that if China is blocked from exploiting the American economy, it would turn its focus toward draining the UK instead. If the Chinese vampire can't suck the American blood, it will suck the UK dry, he declared. But that kind of rhetoric is increasingly out of sync with the complex reality on the ground. In truth, Chinese foreign direct investment in the UK declined by 27% year-over-year in 2024, according to the Rhodium Group. And Britain, for its part, hasn't been shy about setting boundaries. It has already shut China out of key sectors like nuclear power and telecommunications. The decision to exclude Huawei from the country's 5G infrastructure, led in large part by intelligence agencies like MI5, was one of the most visible signs of Britain's new assertiveness. What figures like Navarro fail to grasp is that the UK's actions aren't born of weakness or naivete. They are rooted in pragmatic calculation. Fiona Hill, a former advisor on the US National Security Council, argues that London's choices reflect not submission to foreign pressure, but the careful balancing of national interest. The UK is treating trade not as an ideological battlefield, but as a forum for negotiation, leverage, and long-term strategy. That, perhaps more than anything else, reveals the widening philosophical gap between Washington and London. The evolving trade conflict between the US and China is no longer just about tariffs or market access. It has morphed into a battle of narratives. While Washington tries to frame the struggle as one of economic dominance and moral clarity, the UK sees it through a more complex lens, one shaped by domestic fragility and international nuance. Under Donald Trump's leadership, the US is fighting to project a message of strength and revival, even as the numbers tell a different story. The American economy contracted by 0.3% in the first quarter of 2025, and real wages have dipped by 1.1%. On the other side of the Atlantic, the UK faces its own challenges. Youth unemployment has climbed to 5.3%, and housing starts have plunged 22% year over year. Both governments are under pressure. Both know that economic decisions now carry as much political weight as electoral promises. That pressure is fueling what Dr. Wen Tai-sung, a scholar at the Australian Centre on China in the World, calls a two-level game. Leaders like Trump and Reeves aren't just negotiating with each other. They're also negotiating with their own electorates. Trump's narrative is about restoring American industrial power and economic nationalism. Reeves, by contrast, is emphasizing resilience, diversification, and Britain's ability to thrive in a multipolar global system. Both are under immense scrutiny. Every trade decision, every diplomatic maneuver is intertwined with political survival. And in such a high-stakes environment, even sound economic reason can be drowned out by the noise of political expediency. Despite public statements of openness, neither the US nor China appears willing to make the first real move toward de-escalation. The Chinese Ministry of Commerce has said it's evaluating negotiation options, while US Treasury officials insist the door is open. But these declarations are laced with strategic ambiguity, a tactic as old as diplomacy itself. Echoes of Cold War-era maneuvering are clear, with both sides sending mixed signals, buying time and avoiding clear concessions. A recent post from a Weibo account linked to Chinese state media hinted at the power dynamics beneath the surface, claiming, "The US must be the more anxious party." Meanwhile, US Treasury Secretary Scott Bessent has suggested that a big deal could be possible, if China is serious. But the vagueness is no accident. It is part of a calculated delay. Financial markets are responding. Data from the Commodity Futures Trading Commission shows that by April 2025, traders had built $17.2 billion in net short positions against the US dollar, up from $9.8 billion in January. Bloomberg's dollar index is down nearly 10% year-to-date, dragged lower by rising trade imbalances, growing policy uncertainty, and weakening import flows. The spread between US 10-year treasuries and Chinese government bonds has narrowed to levels not seen since 2006, eroding the traditional incentive for global investors to favor American assets. This isn't just a short-term fluctuation, it's a shift in sentiment. Analysts like Ruchir Sharma from Morgan Stanley argue that the trade war has moved beyond tariffs and retaliations. The dollar itself is now under pressure, a casualty of America's industrial vulnerabilities and policy volatility. Meanwhile, China is managing a slow, carefully controlled float of the yuan while rolling out a massive $1.5 trillion domestic stimulus, without triggering capital flight or investor panic. It's a show of economic discipline in sharp contrast to the turbulence plaguing US markets. The global economic chessboard is being reconfigured. The trade war, once seen as a bilateral standoff between the US and China, has transformed into a multilateral realignment. According to recent WTO data, China's exports to the BRICS bloc surged by 19.4% year-over-year in the first quarter of 2025, while exports to the US plummeted 31.7%. The European Union is also adapting, with internal trade up 12%, spurred by efforts to diversify supply chains and reduce dependence on external partners. In this new landscape, the UK finds itself walking a tightrope between two economic giants. It's simultaneously pursuing trade negotiations with Trump's America, focused on reducing tariffs on agricultural goods, while trying to safeguard frictionless commerce with the European Union. It's a high-wire act with little room for missteps. Historian Adam Tooze has warned that this may be the defining stress test of globalization's next phase. The ideological lines that once defined global trade are blurring, giving way to a new framework driven by labor costs, inflationary pressures, shipping logistics, and strategic redundancy. The bigger question is no longer whether the world is decoupling from a US-led order, but whether it is collectively repricing it, rebalancing risk, redefining leverage, and redistributing influence. Are governments still shaping the rules of global commerce, or are markets and investors taking the lead? Are we watching the decline of unipolar dominance or the birth of a truly multipolar trade system? One thing is certain, the old assumptions no longer hold. Power is fragmenting, influence is migrating, and the future of global trade will likely be shaped not by who shouts loudest, but by who adapts fastest. So what do you think? Are we witnessing the end of an era or the messy birth of a new one? Share your thoughts below.